Welcome to the Week Ahead, brought to you by Inverse. Investing makes sense when you learn by doing. Markets head into the week, balancing the macro calendar against rising geopolitical tension. The war has become a meaningful driver of volatility across energy, shipping, and broader risk sentiment. But investors are still looking to this week's inflation and labor market data for clearer signals on the underlying economic trajectory. After last week's soft U.S. jobs report and sticky wage growth, the focus now shifts to whether inflation is easing or simply shifting. With major releases from both the U.S. and Canada, this week offers several data points that could reshape expectations for spring rate cuts. Here are three important events this week. First is the U.S. February CPI report. Markets will be watching for confirmation that January's firm inflation readings were a one-off rather than the start of a re-acceleration. Next is the U.S. January PCE, the Fed's preferred inflation gauge, alongside household income and spending momentum. This will tie into the sticky inflation theme emerging from last week's wage data and provide some data on whether consumption is cooling or if people feel shopping is cheaper than therapy. And thirdly, the face-to-face Canada-US CUSMA talks resumed on March 6th, the first time since Trump halted them last October because he wanted to watch the World Series ad-free. In our ongoing earnings watch, this week includes reports from Adobe and Oracle, two companies sitting on opposite ends of the AI narrative. Oracle continues to benefit from the AI-driven build-out of cloud and data infrastructure demand, while Adobe faces growing questions about whether generative AI will compress the value of its creative software. Their results should offer a useful snapshot of how AI is reshaping both the picks and shovel side of the industry and the incumbents whose products risk being disrupted by it. In our sector spotlight this week is the consumer discretionary sector, which sits right at the crossroads of this week's macro story. Last week's soft U.S. jobs report raised questions about income momentum, and this week's data will help determine whether consumers are still willing to spend or beginning to pull back. If inflation remains sticky or wage growth cools further, discretionary spending could be the first area to show strain. Two things this week that could surprise markets. Firstly, CPI is expected to remain largely unchanged at 2.4%, or rise slightly to 2.5%. However, some market analysts are concerned that earlier producer price increases are beginning to filter through to consumer prices. If so, it could result in an unexpectedly hot CPI. Secondly, with respect to the ongoing war, the markets have been pricing in a contained scenario. A shift in the conflict scope or geography would challenge that assumption. With geopolitical risk rising and inflation data back in the spotlight, markets face a challenging mix of uncertainty this week. The war has introduced a level of unpredictability that can shift sentiment quickly, especially if energy or shipping routes are disrupted. Layered on top of that is the possibility that inflation proves stickier than expected, which would complicate the case for spring rate cuts. Together, these forces create a backdrop that leans risk-off, with investors likely to stay cautious until there's clearer evidence that both inflation pressures and geopolitical tensions are stabilizing. Well, that's all for the week ahead. Folks, sometimes assumptions need to be challenged and difficult questions asked. If you find yourself in that situation, remember what they said to Socrates when he challenged the status quo. Nobody likes you very much.